Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly Video for July 17th, 2018. Let me set the stage for you. The S&P is up in the 2800 volume, which typically measures participation or interest or activity on a stock. We like volume to go with price. Volume is one of the lowest levels since the 4th of July half-day trading session. Really have to go back to December 2017, and that was a holiday period when the S&P daily volume was this low. That does not build bullish confidence. Throw on the mixture an overextended, overbought S&P, kind of like this back into the last period here in June. And we have Netflix gapping down 50 points. All that together sets the stage for a bearish bloodbath of a Tuesday. And so our game plan, our strategy, our thought process is to go short, is to be bearish, is to play these downside activities very aggressively. We can do that. That's the easy part. But TheoTrade, what happens when things go wrong? We'll talk about that in tonight's video. We can see this because it's hindsight, but today's educational lesson, big lesson, centers on planning for the unexpected or planning for the improbable. What to do when things go really, really wrong with our plan. And mainly the first thing we do is not panic. The more we plan, the more we prepare, the more we anticipate what can go wrong, the more we'll be ready to act and even have it written down in the case that it does. Main idea is if traders, when they see similar information, they'll think similar thoughts and they'll put on similar positions. But wait, they also put stop losses above their resistance, or if it's going down, support levels, in the event something unexpected happens. There's a weird thing that occurs when a lot of people see a similar event and then the market tricks and therefore traps them, forcing them to the exits rapidly. We call this on the upside a short squeeze. If it happens on the downside, it's called a long liquidation flush. But the logic's the same. Be prepared for either outcome. Certainly can tip a directional bias, and that was clearly to the downside. But what happens if we wake up and the market turns the other way? That's what was perverse about today's session, is that the market initially gapped down. So we're looking at this, we're seeing the market, we're getting our game plan, our thought process confirmed. Market's going down, Netflix is going down, all the tech stuff are going down, etc. Financials are flat. But again, at what point do we abandon a bearish dominant thesis or logical bias and then flip the other way? The first thing we talk about if something goes wrong is to protect your risk, protect your capital. So if all the stars align for a certain directional move to happen, but it doesn't, at what point will you exit the position or put on some hedges? A lot of traders, when they do this, especially when things are a little bit too obvious, is that they get deer in the headlights syndrome. They'll see the market go down, put on positions, scale in on the way up, and then each little new high gives them pain because that results in financial losses. And collectively, don't just think about ourselves. Across the whole trading community, those same pain points and decisions and woulda, coulda, shouldas are occurring globally. So that does result in extended upside action. We always say, if something should happen but does not, it often leads to a larger than expected movement in the opposite direction. That was the case in the S&P, clearly the case in the Nasdaq. That didn't let up. That continued the whole trading session. Wasn't quite as bad in the Dow futures, and of course the Russell didn't really have a downside move at all and didn't really result in a trend day. So we did have, as we've been seeing, different perspectives and different ways to look at these markets. The main lesson for today will take you from this bigger picture equity index. Main driver, of course, was Netflix, and that was down. Thought process, it's going to go lower. We usually do get some type of bounce after a gap takes place, but not usually this large. So again, traders who were caught the wrong way, they were long, panicked out, but same thing. Those who were short on the initial break or the afternoon or aftermarket hours or pre-market hours, they had to cover. And it's not just to the downside when things go wrong. This happened also in gold. We'll take a look at gold and use the same logic. I think the purpose of this video is to find out what we do, what our plans are in worst case scenario or disaster plans. Options can certainly help with that, but if you're trading swing or intraday positions and the market keeps going against us, first thing we do is protect ourselves if something unexpected happens. The other thing is to try to profit from it by going with the unexpected directional movement. That can often occur quicker and result in bigger moves than we otherwise would have imagined to the downside or the opposite outcome. So we had a thought process similarly that gold into support at about 1240 was going to hold, play up away from its support level. But as we can see here, the session began a little bit with a bounce and that resulted in not just a break beneath, but our specific and written out, planned for alternate thesis. And that was just if gold cannot break, cannot bounce, can fail to bounce off of this 1240 level, it could result in a rapid sell swing breakdown beneath. And that's what set the stage. This failure to hold, failure to support, led to a trend day down in this precious metal. So there's the initial downside. There's the initial break, 1238. And from that point, off to the races. If you're trading intraday trend style, the only trade that really was available was the first pullback. But that's not what I want to talk about. I want to communicate this concept of avoid deer in the headlights. If something goes wrong, it's certainly not your fault, and it's just the alternate thesis. Don Kaufman talks about the probability, right? The probability and the hammer. So if there's an 85% probability of a position expiring worthless or an option sold contract, and that's fine, you may get that very well, but what happens the 15% of times that it doesn't? And those 15% of times when something goes wrong, when a way out of the money option you sell winds up being in the money, what do you do at that point? So protect yourself. Lots of ways to do that. Lots of ways to hedge and protect before expiration. But in this scenario, I want us to be safe when something unexpected happens. That may mean just taking an immediate stop loss. That may mean putting on an immediate hedge, closing positions. What I don't want us to do is get caught in this, but so-and-so said, or but the indicators tell me, or my strategy says, or it just can't go any lower. And so we wind up riding out a long position, well-intentioned and with the probability on our side, but the reality did not match up with probability. The outcome was that 15% of the time we get the hammer and not the reward. So that is what we're discussing. So gold, instead of bouncing off support, fell roughly $10 to $15 lower. So that's what we're going to watch this experience. And that happened at the same time the S&P gapped down, did a V spike, violent reversal, along with the Nasdaq and Netflix. So first is to protect ourselves, have the plan. A lot of traders simply have their gut intuition, or I think it's going to bounce, or I think it's going to fall. And that's not really a trading plan. That's just kind of hoping and wishing. Even if something goes well with probability, have an exit thesis, have an exit plan, have a worst case scenario. That may be a resting order. It may be a disaster stop. It may be some other way to adjust your option positions, or it may just be a flatten the position exit. Hit the flatten button. Just get out. Don't ask questions. Just exit, and don't let something that has good probability, has maybe even extremely high probability, result in a very large, unexpected, bigger loss. It's that deer in the headlights concept. Always have your plan ready, trade the plan, but be ready to adjust when something really unexpected happens. This is Corey Rosenblum, and you're watching the Theo Nightly video for July 17th, 2018.